Right now, the world's largest financial institutions are quietly handing over transactional authority to autonomous AI workers. But the true cost isn't on the balance sheet. It is ticking inside the global bond market. Welcome to this explainer on the latest macroeconomic data, where we're mapping out a highly structural financial paradox. We are looking at an unprecedented capital expenditure boom designed to fund the infrastructure of the intelligence economy. But, as we'll explore today, this boom has quietly morphed into a systemic sovereign debt vulnerability. We're relying on data from the Bank for International Settlements, the IMF, hyperscaler SEC filings, and leading macroeconomic research to unpack exactly how this transformation occurred.
Let's step right into Act I, the transactional shift.
Before we can accurately examine the debt contagion, we really have to map out the fundamental paradigm shift that's currently underway. The global economy has officially crossed the threshold from legacy predictive algorithms to agentic AI. We're no longer talking about systems that just passively respond to human prompts. Agentic AI means these systems are now independently pursuing goals, adapting to changing contexts, and executing complex workflows with minimal human oversight. They are actively solving problems.
To understand just how fast this transition is happening, consider a recent comprehensive survey by MIT Technology Review and the Cloud Security Alliance. 62% of financial services firms have already deployed these agents. Even more staggering, 93% of those firms have granted these agents operational autonomy. And looking ahead, 85% of these institutions expect AI agents to directly facilitate payments. They are speeding toward autonomous finance far faster than the underlying security models can fully adapt.
And what makes this shift so inevitable is the undeniable operational efficiency driving it. It is drastically accelerating global finance. Take the Bank of Singapore, for example. By integrating agentic AI, they seamlessly reduce their notoriously complex Know Your Customer wealth verification process from 10 grueling days down to just one single hour. This is the transactional shift in action. It's a profound restructuring of banking speed and scale.
Which brings us to Act II, the trillion-dollar grid trap. Transferring macro-transactional authority to these AI agents requires a staggering amount of raw compute power. Driven by this insatiable demand, capital expenditure by the 5 major hyperscalers, Alphabet, Amazon, Meta, Microsoft, and Oracle, has absolutely exploded. We're tracking a leap from $155 billion in 2022 to an aggressive $226 billion in 2024. And now, we're looking at a projected $755 billion by 2026. This is an infrastructure arms race accelerating far beyond normal corporate treasury limits. It's essentially industrial mobilization masquerading as corporate spending.
To properly contextualize this on a macroeconomic scale, you have to realize that these private technology monopolies are deploying capital that approaches the total annual defense budget of the United States. It wholly eclipses the national gross domestic product of entire sovereign nations like Sweden and Argentina. We are quite literally witnessing private corporations behaving as infrastructure sovereigns.
But this sovereign-level industrial mobilization is slamming directly into a brick wall of severe physical infrastructure constraints. Our current electrical grids were simply not designed for the continuous, high-intensity thermal loads of AI data centers. This threatens to trigger a 44-gigawatt U.S. electrical grid shortfall over the next 3 years. To put that into perspective, that is equivalent to the summertime electricity consumption of the entire state of New York. And it's a physical constraint that simply cannot be solved quickly with capital alone.
As this aggressive AI capital expenditure pushes toward roughly 2% of the total U.S. GDP, which, by the way, dwarfs even the massive telecommunications fiber build-out of the late 90s dot-com bubble, this unprecedented financial burden has to be offloaded somewhere. The capital window might be wide open, but these physical constraints are forcing a severe reckoning on corporate balance sheets.
And that leads us to Act III, the sovereign debt trigger.
With internal cash flows completely tapped out by that physical grid expansion, we are witnessing the end of an era. For a decade, tech giants enjoyed asset-light models overflowing with free cash flow. In 2023, their capex consumed a highly manageable 40% of operating cash flow. But by 2026 and 2027, macroeconomic firms like PIMCO project that hyperscalers will reinvest an alarming 94% of their operating cash flow into infrastructure. They are completely abandoning their legacy models to become massive issuers of long-duration debt.
This explosive wave of corporate bond issuance has utterly transformed credit markets. AI-related debt has now ballooned to $1.2 trillion, representing 14% of the JP Morgan U.S. Liquid Investment Grade Index. It has officially surpassed the banking sector itself in credit market concentration. Make no mistake, the AI narrative has fully transitioned from a productivity story to a funding story. Now, if the bond market is the visible risk, shadow borrowing is the invisible one. Even more concerning to regulators at the Bank for International Settlements is this rise in unregulated private credit. We're seeing loans made by non-bank entities to software companies surge past $500 billion. And the collateral backing this up? It isn't physical land or hard assets. It's based almost entirely on highly speculative future AI revenue projections.
This exposes a profound fragility within the tech ecosystem itself. We're witnessing what the BIS flags as unstable circular financing. It's perfectly illustrated when tech giants invest billions into AI labs, and then those exact same labs immediately commit those funds right back to the tech giant for multi-year cloud compute contracts. It artificially inflates nominal revenue, creating a self-inflating ecosystem where the exact same capital is being pledged multiple times over.
But the ultimate risk here is a temporal mismatch quietly creeping up on corporate income statements. Right now, over $1 trillion in undepreciated hardware is sitting silently on balance sheets, classified as assets not yet in service. Between 2026 and 2028, these assets will officially transfer to fixed assets. That is going to trigger explosive, merciless depreciation charges that will heavily compress profit margins, regardless of whether the AI infrastructure is fully monetized yet.
If those AI revenues fail to materialize in time to service this unprecedented debt load and these massive depreciation hits, the BIS maps out a chilling systemic contagion pathway. It begins with an AI commercialization gap, which leads to a rapid widening of credit spreads as risk gets repriced. That triggers a shadow banking liquidity freeze, essentially a non-bank run, highly reminiscent of the 2020 dash for cash. Ultimately, this all culminates in a severe macroeconomic contraction driven by shrinking equity wealth.
So we're left staring at a $1 trillion vulnerability mapped meticulously across global bond markets. If this historic capital expenditure becomes a bridge to nowhere, financed at the absolute top of the credit cycle, who bails out the machines?